simple foundation area of our learning known as the preparation of the statement of financial position. A statement of financial position is a statement prepared to show the financial position of a business or an organization. It is a statement that shows the assets or properties of a business on one side and how these assets are gotten on the other side. Let us see the ruling of the statement of financial position. The first thing in the ruling of the statement of financial position is to show the name of the owner of the business, that is entity concept, which is Victory Enterprises. Then what are we preparing? We are preparing for Victory Enterprises a statement of financial position as at 31st December 2021. This means that this business started by 1st January 2021 and will be ending the financial year transaction by 31st December 2021. Of course, accounting year is usually 1 year, 12 months. And we are preparing this for Victory Enterprises based on 12 calendar months. The next thing we do is to fix the assets on this side and how the assets are gotten on this side. The assets will be divided into two: the non-current assets and the current assets. Then the total of the non-current assets and the current assets will give us the total assets. And on this side, we now show how the assets are gotten. It should be noted that the first format we are using is the vertical format. After that, we are going to use the horizontal format for the sake of our foundation knowledge. Now recall that we defined the statement of financial position as a statement that shows the assets of an organization on one side and how these assets are gotten on the other side. We're going to be looking at the asset side first. Under the asset side, that is the properties of the business, we're going to be looking at two forms of assets: the non-current assets and the current assets. If you are to walk into a business premises and you are expected to prepare for them a statement of their financial position, if you look around the environment, the first thing you take into consideration is their properties, because those are the physical things you are seeing. You look at their land and building, the plant and machineries, the furniture and fittings, the motor vehicle, equipments, and other assets. Now, by the time you are bringing these tangible assets together and trying to evaluate them, you are already preparing for them the statement of financial position. And the area of the statement of financial position that takes cognizance of these tangible assets is the area that is underlined as the non-current asset. The non-current assets includes properties or assets like land and building, plant and machineries, motor vehicles, equipments, and so on. These are assets that the organization acquire not for sale but for use in the business for generation of wealth. You must also take into consideration things like investment and also the intangible assets. Let's go to the board and display what we just said. You have walked into the organization, looked around, you have collected the source documents, and you have been able to discover that this organization, Victory Enterprises, has land and buildings worth $50,000. Plant and machines worth $40,000. Motor vehicles worth $30,000. Equipment worth $25,000. You also discover that apart from these assets, they made an investment in another organization to the tune of $10,000. You also discover that the value of the intangible assets is $5,000. We shall talk more about intangible assets when we progress. They include things like goodwill, patent, and so on. Now, if you add all the figures you've gotten here, 50 plus 40 plus 30 plus 25 plus 10 plus 5, it gives you 160,000. The arrangement of these assets in an order of permanence is known as marshalling. You can see land and building is more permanent than plant and machineries. Plant and machineries, they are more permanent than motor vehicle, and motor vehicles are more permanent than what? Equipment. Now, these assets are purchased in the organization, not for sale. This is not what they are selling, but they are using these assets to run the business, to generate wealth. And they have also made investment in another company, maybe in the form of purchase of what? Shares. They also have intangible assets to the tune of 5,000. The non-current assets are not the only assets of the organization. There are also some other assets known as the current what? Assets. All other assets that are non-current assets, investment, or intangible assets are current assets. The current assets are those assets that can change from one form to another. Sometimes they can be referred to as liquid assets. They include items like inventories, receivables, marketable securities, amount in the office as cash, and amount in the bank. They also include things like prepaid amount or prepaid expenses and other liquid what? Assets. It is the combination of the current assets and the non-current assets that makes up the total assets. It should be noted that some other items might be included alongside the current assets and the non-current assets. There could also be adjustments on depreciation and other areas. But as we progress in our studies, we shall come to know more about these adjustments and these other items. Let's go to the board and include items of current assets to the non-current assets. So we have the current assets alongside with the non-current assets, and they include items like inventories, 8,000 or closing inventory. Account receivable, 6,000. Account receivable may include, among others, those customers that goods were sold to on credit. And since they have not paid, as at the end of the accounting period, they form part of our current assets, since they can be collected within one accounting period. We have marketable securities. Marketable securities are liquid financial instruments that can be quickly converted into cash at a reasonable price. They include things like common stock, treasury bill, and so on. Now, since they can be easily converted to cash and they form securities or assets, they now form part of current assets. We have the cash that the business has in the office. This cash forms part of the current assets. We also have the cash they have in the bank. This is also part of the organization's assets, which falls under current assets. We also have prepaid expenses. Of course, here we have cash, 15,000, bank, 18,000. 18,000. Now, prepaid liabilities is also part of current assets. They represent expenses paid against the future. For instance, if in this accounting year we are supposed to pay $2,000 and we paid $3,000, the extra $1,000 paid in respect of such expenses represent prepaid liabilities. For instance, if we are supposed to pay rent of $3,000 and we paid $4,000 for the accounting period, the extra $1,000 constitutes prepaid liabilities or prepaid expenses. It is prepaid because the landlord is owing us $1,000. It is part of accounts receivable, that is people that are owing us. But since it's in relation to liabilities, it is called prepaid liabilities. Then we have other liquid assets, and we attach 500 to it. What we do is very simple. We add the total of the non-current assets to all the current assets and get our total assets. Of course, there might still be some items that are not included here. But as we advance in this, our learning, we shall bring many other items into consideration. So for now, let us add and find out our total assets. If you add the total of the current assets items, we have inventory 800, account receivable 6,000, marketable securities 3,000, cash 15,000, bank 18,000, prepaid liabilities 1,000, and other liquid assets 500. You give us $51,500. Now, if we add the non-current assets 160,000 plus current assets 51,500, it gives us $211,500. Remember that in adding the non-current assets here, we included investments and intangible assets. So if we add the total of the non-current assets, 160,000, plus the total of the current assets, 51,500, it gives us a total asset value of 211,500. The question now is, how did Victory Enterprises get these assets? How did Victory Enterprises finance these assets? This brings us to the other side of the statement of financial position, where we are going to state how Victory Enterprises got the non-current assets and the current assets. The question now is, how did Victory Enterprises obtain the total assets of $211,500? Of course, on close examination of Victory Enterprises source documents, the various sources of finance will be disclosed. And of course, from our preliminary knowledge of accounting, Victory Enterprises will tell us that some capital were involved, that is initial amount introduced to start the business. Of course, if there have been any net profits retained for the accounting period or the past accounting period, it will be stated. And if there are any drawings, it will also be stated. At the end of the day, what we are getting is the net capital. Then, of course, we take other items like the non-current liabilities and the current liabilities into consideration. For now, let's see what makes up Victory Enterprises net capital. discovering that the total capital introduced to start the business is $150,000. During the periods, they were able to retain profits of $20,000. Then there were drawings in cash or in stock of $500. Remember that the net profit belongs to the owner of the business. So anytime net profit is made and retained, it is added to the capital. So for the accounting period, it becomes 150 plus 20, that is 170,000. Then you deduct either cash or stock drawings, 500. So the net capital is $169,500. Remember we said that the statement of financial position shows the assets of the business on one side and shows how the assets are gotten on the other side. On this side, we have been able to show just $169,500 against the total asset of $211,500. The equation is, where did they source other money to complete the $211,500? Of course, that will compel Victory Enterprises to bring to play other sources of finance like the non-current liabilities. So under the non-current liabilities, we are going to be looking at the long-term loan, other forms of finance. Victory Enterprises takes us to other areas of financing the business known as non-current liabilities. Under the non-current liabilities, we are going to be seeing things like the long-term loans, like debentures, another form of finance that its repayment takes a long period of time, in most cases more than 1 year. Let us see the items that makes up non-current liabilities for Victory Enterprises. Now, from the source document of Victory Enterprises, we have been able to find out that the non-current liabilities is made up of the long-term loans. We can use the term debentures in a limited liability company. If from investigation, we have been able to discover that the non-current liabilities of Victory Enterprises is made up of long-term loans of $20,000, which can be in form of debentures. Then it now constitutes part of the loans used in financing the business to obtain all these assets. Of course, you can see the figure already included alongside with the capital introduced plus net profit of Victory Enterprises. If you add these two figures, $169,500 to $20,000, it will give us $189,500. Of course, it is not equal to $211,500 of the total assets. So the question is, how did Victory Enterprises obtain $211,500 assets? That will bring us to Victory Enterprises' current liabilities. The current liability constitutes short-term finances to the business. The current liabilities are those liabilities that are expected to be offset within one accounting period. They also constitute part of the way in which or through which businesses are financed. They include account payables, short-term debts, overdrafts, and accruals. These areas of finances are short-term in nature, since they are expected to be offset within an accounting period. Just like the current assets, they are easily convertible. Now, the current liabilities items includes account payables, 7,000. This represents suppliers that they purchase goods on credit from, $7,000. Their short-term debts, as the name implies, they are debts that are repayable within an accounting period, that is 12 months. Then we have overdraft, which shows amount collected in excess of what they have in the bank, 8,000. Then we have accrued expenses, expenses that the organization incurred within the year that has not been paid for. All these items constitute the current liabilities, and these money are supposed to have been paid, but since they are still owing, they are being used to finance the business, to be paid back in a later period, which is expected to be within an accounting period, 1 year. Now, from every indication, it is clear that Victory Enterprises has financed the assets of 211,500 through personal capital, which includes the capital, the net profit retained, less drawings. Then the non-current liabilities in form of long-term loans, which are loans that are repayable over a long period of time. In most cases, more than 1 year. It could be up to 5 years or more. Long-term loans in the form of debenture are loans that the business has collected and will be repaid after some period of time, which is usually more than 1 year. Of course, debenture represents a form of loan. We are going to explain debentures as we progress in other areas of our study. Another area that was used to finance this business is the current liabilities, which is 22,000. The non-current liabilities is 20,000, and the current liabilities is 22,000. So if you add the total source of finance, we have 169,500 plus 20,000 plus 22,000, which gives us exactly 211,500. Of course, the total assets should be equal to the total liability plus capital. That is accounting equation. If you add the capital plus the total liabilities here is 20,000 plus 22,000, which is 42,000, which is the total liabilities, plus the capital, it must be equal to the total assets. We have come to the end of the foundation study in the preparation of statement of financial position. We are going to present this analysis using the horizontal format and also reframe everything in this statement of financial position to become an assignment for you to practice. Remember, if you have not practiced, you have not studied. Now we are going to transform the T format into the horizontal format, and thereafter we are going to look at what accounting equation means. The horizontal format looks this way: Victory Enterprises Statement of Financial Position as at 31st December 2021. What we do here is this. This is the T format and this is the horizontal format. The non-current assets and the current assets items will be brought firstly on the horizontal format. You can see the non-current assets and the current assets. So we have land and buildings, 50,000, plant and machines, 40,000, motor vehicles, 30,000, equipment, 25,000, investment, 10,000, intangible assets, 5,000. If you add everything, it's going to give you 160,000. Then we have the current assets, inventory, 8,000, accounts receivable, 6,000, marketable securities, 3,000, cash, 15,000, bank, 18,000, prepaid liabilities, 1,000, other liquid assets, 500. If you add everything here, it's going to give you 51,500. Now, 160,000, which is the non-current assets, plus 51,500, which is the current asset, gives us 211,500. That is the total assets. Now, remember we defined the balance sheet as a statement that shows the assets of an organization on one side and how the assets are gotten on the other side. So, when we are getting the total assets, how did they get the assets? It will now be shown on this side. This implies that all the liabilities and capital items will be shown under the total assets. So you discover that the capital, non-current liabilities, and current liabilities will be shown under the total assets as the items that finance the business. So we now have capital and liabilities shown under. It is through capital and liabilities that this business was financed. We have capital, 150,000, net profit, 20,000, drawings, 500, deduction. So we have 150,000 plus 20,000 minus 500, it gives us 169,500. Then we now look at the non-current liabilities, which is the long-term loan, which can be in form of debentures. That one is 20,000. Then we now have the current liabilities. We have account payables, 7,000, short-term loans, 5,000, overdraft, 8,000, accrued expenses, 2,000. So if you add 169,000, which is the net capital figure, plus 20,000, which is non-current liabilities, that is long-term loan, which can be in the form of debentures, 20,000, plus the current liabilities items, 7,000 plus 5,000 plus 8,000 plus 2,000. That is added from here to here, you have a total of 215,500. From our analysis now, a statement of financial position can be defined as a statement that shows the assets of the organizations and the liabilities and capital. Of course, it is a combination of the capital and the liabilities that makes up the total what? Asset. Of course, this figure must be equal to this, because if you have a car of $1 million and you are told to show us how you got the money, what you show us is exactly 1 million, not less than 1 million or more than 1 million. So in this instance, the whole assets of the organization, which gives the total assets, is 211,500. How did they get these assets? Through the capital of the owner of the business, through long-term loan that the owner of the business employed to finance the business, and also current liabilities item. Like account payable signifies those things they bought from suppliers on credit. Of course, what it shows is that some of this money has not been paid. They could be under cash or bank, or they could have been used to finance the purchase of some of this investment. So the fact remains that in the balance sheet, the whole asset is shown, giving us the total assets, and the capital and other sources of finance, which are the liabilities area, combined must give the total assets, 211,500 and 211,500. Now, from what we have analyzed, we can talk about accounting equation. Accounting equation is the equation that shows the equality of the total assets of an organization to the liabilities plus capital, just as we have explained. So let us look at how accounting equation looks like. Accounting equation. Capital plus liability equals to total assets. That is what we call accounting equation. That is, it shows the equality of capital plus liability to the total assets. Of course, the total assets was financed through capital plus liabilities. Now, we have the capital as 169,500. If you watch, you see it here. 150,000 plus net profit minus drawings gives us 169,500. That is the net capital. You can see it here. Plus liabilities. When we talk about liabilities, we are talking about non-current liabilities plus current liabilities. Of course, the total of the non-current liabilities is 20,000. You can see it here. That is, the liabilities is 20,000 plus 22,000. 22,000 is the total of the current liabilities. If you watch it there, you see 22,000. So we have capital 169,500 plus liabilities, which is non-current liabilities plus current liabilities. If you add the capital plus non-current liabilities plus current liabilities, it will give you 42,000. That is 20,000 plus 22,000 gives us 42,000. Now, if you add this 42,000, which is the total liabilities, to the capital of 169,500, you now have 169,500 plus 42,000, which gives us $211,500. Of course, we have the total assets, which is made up of 160,000 plus 51,500. The total of the non-current assets is 160,000, including investment and intangible assets. Then the total of the current assets is 52,500. Now, 160,000 plus 51,500 gives us $211,500. That's exactly how we got the total assets, which is 160,000 plus 51,500. If you add both of them, it gives you 211,500. And you can see 211,500, we brought it down here, is also equal to 211,500. So when you add up the capital plus total liabilities, which is made up of non-current liabilities and current liabilities, if you add them to the capital, it gives us 211,500. And this must be equal to total assets, which is made up of non-current assets plus current assets, which is 211,500. You can see it here. 211,500 is equal to 211,500. This is the capital plus liabilities added, and this is total assets, which is made up of non-current assets plus current assets. And that is exactly what the accounting equation is trying to show. It shows the equality between the capital plus liability to the total assets. Or simply put, it shows the equality between the total assets and total liabilities. That is accounting equation. Sometimes in an exam, some of these variables could be removed. For instance, the liabilities could be removed and replaced with variable x, and you'll be told to find the liabilities. In any situation, you can use mathematical notation 211,500 now represents capital plus liabilities, while it is equal to another 211,500, which represents total assets. Of course, that is what the accounting equation is all about. It shows the equality between capital plus liabilities to total assets. Or simply put, it shows the equality between total assets and liabilities. That is accounting equation. Sometimes they could remove some figures. They could remove the liabilities and replace it with X. Or they can remove the capital and replace it with S. Whichever way it is given, you can always make the S the subject of the formula and obtain the requirements. If you have problem with elementary mathematics, you can visit our sites on general mathematics and foundation in mathematics. We have come to the end of our foundation lectures in the preparation of the statement of financial position. Of course, you have to practice the assignments so that you can progress alongside with us. Without such practice, it becomes difficult for you to forge ahead. These are the foundation areas. The double entry principles, which brings the cash book into consideration, and the statement of financial position, and the statement of profit or loss account and other comprehensive income. These three areas and a part of bank reconciliation makes up 100% of what you are going to be learning in accounting. So if you don't have the basis or the foundation, and if you don't progress alongside with us, then you will find it difficult to adjust in other areas of accounting. Thank you very much.